Good morning, everyone. I have only 30 minutes, so I'll directly go to the 2019 past paper, question number 2, capital budgeting. I discussed the past paper in English. If any mistake, please adjust and go forward. We'll see the past paper. First para, it's not important because they said that what will they product. In the second para, sales of the car expected to be 100 units in year first and increase at the rate of 20% per annum in next 2 years. So they increase 20% in second year and third year, and 150 units are expected to sell from fourth year onwards for the remainder of the project life. They have said the selling information. Year 0, year 1, year 2, year 3, year 4 to lifetime. First year no any selling units. First year 100 units. Second year increase 20%. So 150 and 120 units. Third year also same, increase 20%. So 144 units. Fourth year expected to sell 150 units. Third para, in the case of research and development, company already spent 50 million in the developing the project. 50 million developing cost. So it is a sunk cost. We put the working as sunk cost 50 million. After that, further investment of 150 million in a new manufacturing facility will be required at the beginning of the project. So in the 0 year, investment 150 million. So cash outflow 150 million in 0 year. And next, they said it is expected that the new manufacturing facility could be sold for cash of rupees 225 million at year 25 at the end of the project. So end of the project is year 25. They said that here the scrap value is 25 million. So cash inflow in last year 25 million. Year 25, cash flow 25 million. Project life also 25 years. So we want to put 25. We can't use the scrap value for year 2, year 4 to year 25 because scrap value only related to the year 25. When we use the scrap value in here, that meaning scrap value used to year 4 to 25, but scrap value only used to year 25. So 7 minutes ago, the manufacturing facilities will be depreciated over 25 years using the straight line method. So every year depreciations are same. That's why they said that straight line method. When we calculated depreciation, we want to use the cost minus scrap value divided by number of years. Regarding this information, cost is 150 million, scrap value 25 million, number of years 25. So the answer is equal 150 million minus 25 scrap value divided by number of years 25. So depreciation is 5 million. Here I am using a note, no impact in cash flow and tax calculation because depreciation is not a cash inflow and cash outflow. What is the next point? The project will also require an investment of rupees 10 million in working capital at the beginning of the project. So beginning of the project, 0 year working capital 10 million. When we calculating cash flow, working capital in 0 year 10 million. You don't forget that when we use the working capital, it is recovered in last year. It meaning 25th year recover, that meaning cash inflow 10 million. After that, the selling price of the new product will be 2 million and the variable cost per unit will be 1 million. They said that selling cost per unit is 2 million, variable cost per unit is 1 million. So we use it in the revenue calculation. First year, no any selling price. 2 million selling price, it is same for other years. And the variable cost unit also same to the selling units. 0 year, no any price. First year 1 million variable cost. It is same for after the years. So the contribution, sales minus variable cost equal to contribution. Sales value 200, variable cost 100. So 200 minus 100, 100 is contribution. Next point, the total fixed cost per year are expected to be 50 million, including depreciation. Said that fixed cost is 50 million per year and it is included depreciation. So we want to deduct the depreciation in fixed cost. We already calculated the depreciation 5 million. Now they said that fixed cost is 50 million, depreciation 5 million. So fixed cost per year 45 million minus 45. Here contribution minus fixed cost equal to net profit. 100 minus 45 equal to 55 net profit. Life of the project. Okay. After that, here they give the information about the tax calculation. Before that, we want to put the information in tax calculation sheet. Here copy. Revenue 300, okay. Variable cost variable cost 150, okay. Fixed cost 45. Okay. Here, since the government policy is motivate this type of innovative business, Inland Revenue Department has agreed to charge income tax at the rate 10% from taxable profit. So the tax rate is 10%. The life of the project and agree to the tax exemptions, 0 rate tax for scrap selling value. So they said that 0% tax for selling scrap selling value. So it is no any exemption for the scrap selling value. we put the tax rate. Okay, we will already put that the tax rate 10%. After that, they are saying charging depreciation though the life of the project has been accepted by the Inland Revenue Department in the case of calculating income tax. And when we calculating the depreciation, we can't use the, when we calculating the income tax, we can't use the depreciation. So we want to it convert as the capital allowance. They said that depreciation equals to the capital allowance. So we use the depreciation as the capital allowance minus 5. Already calculated depreciation minus 5. So we use it as a capital allowance. So taxable profit is 50, 70, 90, 400. After that, we want to calculate the tax equal minus value taxable profit multiplied by 10%. And the tax after profit is 45, 63, 84.6, 90. And we can use the tax in the cash flow. Okay, tax after profit is 106 minus value 50, 68, 89, 95, 35. Here is the important one. When we calculate the present value, we want to use the discount factor. Estimate cost of capital percentage is 15. Ignore the impact of inflation. So we don't consider about the inflation. Cost of capital rate is 50%. We want to calculate the discount rate. Here we can use these 3 steps, or we directly use the net profit. These steps. We want to save the time. We can use directly this step. Okay, we want to calculate the discounting factor. We all know in 0 year discounting factor is 1, and first year discounting factor. I'll show the formula of discounting factor. Here n is number of year, r is rate of cost of capital. So we are use the formula. Use the formula 1 divided by 1 plus r. It means 1.15 close bracket number of year 1. Okay, I take the 3 decimals and I'll copy that to the second year. I'll change only the year, second year. Okay, I'll copy to the next one, change the year, third. Okay, here is the most important point. We can't use discount factor in year 4 to year 25 because we can use the discounting factor year 1 to year 3 and year number 25. We can't use year 4 to year 25 as discount. Here we use the annuity factor because here all cash flow are same for all years. I'll explain briefly. Year number 4 to year number 25. I'll use a schedule year number 4 to year number 25. We can use 8, 9, 10, 11, 12. It's waste of time. So I'll use this format only. Here you can see in the discounting factor, we can get the revenue. Year number 1, first year, we can see the revenue 200 and year number 2, 240. The revenue are changed to year by year. When we get the discounting factor, the revenue is 300. It is almost same for all years. So cash inflow 300 are same for every years, but discounting factor rate, the revenue is changed year by year, and we get the variable cost. In the discounting factor, variable cost also changed. Here you can see year number 1, 100, and the variable cost year number 2, 120. So variable cost also changed. When we calculating annuity, 150, variable cost is 150. It is also same for all years. So cash outflow 150 is same for all years. Fixed cost, it's also same. And the tax, here you can see the tax. Tax is 5. In the discounting factor, tax change by year, but when we calculating annuity, tax is 10. It is fixed one minus 10. Okay, profit same for every years. That's why I'll use the term the annuity can be used for years with the same equivalent cash flow. Here you can see same equivalent cash flow 300, 300, 300, and variable cost cash outflow 150 also same, fixed cost and tax 10 also same. So the cash flow is same. So here we can use annuity factor. Here we can use annuity factor. Annuity rate is, here I'll use the annuity. Here also R is the rate of cost of capital, N is minus N minus number of years, equal open bracket 1 minus open bracket 1 plus R meaning cost of capital. Okay, minus number of years 25. We use 25 and close bracket divided by 0.15. Okay, here 6.4. Here we get the cumulative annuity amount of year 1 to year 25. Year 1 to year 25 cumulative amount annuity. Here we get the cumulative annuity. We want to deduct the 1, 2, 3. We get the cumulative annuity factor. We want annuity for year 4 to year 25. So we want to deduct the year number 1 to year number 3. So close the bracket minus sum of the discounting factor. Year number 1 to close the bracket. Year number 3rd. I use the formula here, cumulative of 25 years, year number 1 to year number 25, and I'll minus year number 1 to year number 3. Then automatically we calculate the annuity for year number 4 to year number 25. Here get the annuity factor 25. Okay, so we can get the net present value 392.060. So the net present value is positive. That means net present value greater than 1. So accept the project. So we can accept this project because net present value is positive value. I think you all are understood. Here also we can use the net profit. When we save the time, then we can use the net profit. If time is enough, we can use these 3 steps. Calculating part is over, and we have another 2 theoretical part. B part is factors considered before making the financial decision about the project investment. Before making the financial decision, we consider 3 things: technical feasibility, environmental feasibility, and the social feasibility. And also they ask the net present social value. It is equals to the economic value plus social value. Now time is finished. So I think you understand all this. You understood. I hope you all are understood. And thank you for you all to giving this valuable opportunity. Thank you. Now I wind up the discussion. Thank you all.